Good afternoon. This is just a bunch of odds and ends to wrap up the first chapter. Sarbanes-Oxley 2002. It's kind of ironic that 90% of what we're going to talk about this quarter relates to private companies, but the Sarbanes-Oxley Act was so pervasive it affects so many aspects of public companies, not just accounting. So we at least need to be familiar with it. Two things relate to accounting. Section 302, corporate responsibility for financial reports, says the CEO and CFO are directly responsible for the accuracy documentation of all financial statements. The principal executive officer and financial officer, the CEO and CFO, must certify each annual financial statement and quarterly report filed. 404 is management's assessment of the effectiveness of internal controls. With all financial reports, management's responsible for stating that they're responsible for maintaining adequate internal controls, and management must assess the effectiveness of the internal controls as of year end. The public accounting firm performing the audit shall attest to and report on the assessment made by management. Now let's think this through. This is not unlike financial statements. Management prepares and presents the financial statements. The auditor attests to the fair presentation. They're management's financial statements. The auditor attests to the fair presentation. Here again, management's responsible for providing a report that assesses the effectiveness of their company's internal controls. The auditor then attests to the report made by management. So it's very similar to what we do for financial statements. Words that you need to know: GAAP, GAAS, FASB, SEC, PCAOB, AICPA. You need to be able to convert these into words. I'm always shocked at how many students don't know what the FASB is by this stage of their accounting career. So make sure you know each of these acronyms. GAAP is generally accepted accounting principles are created by the FASB. They're presented in the Accounting Standards Codification, which uses an identifying framework. 310 is the topic, 10 is the section of the topic, 25 is the paragraph, and 3 is the sentence. So it'll guide you right to the sentence if need be. I went to the University of Arizona, so I'm crushed every time I see an accounting standards update. When the FASB issues a new accounting standard, they issue an ASU, an accounting standards update. For general accepted auditing standards, we have two sources, a different source for private and a different source for public. The PCAOB, the Public Companies Accounting Oversight Board, issues auditing standards. They call them AS. The AICPA issues statements on auditing standards for private companies. They call them SAS. So we have big gas and little gas. Historically, there's always been a discussion on should we have big gap and little gap. And we're starting to see a little bit of big gap and little gap. The FASB has a financial reporting framework for small and mid-sized enterprises. They've issued a handful of accounting principles, accounting standards for small and mid-sized enterprise. For the most part, these simplify the disclosure and the accounting to reduce the burden for small and mid-sized companies. Business risk, information risk. I like the idea of risk is something that keeps an entity from meeting its objectives. We'll come back to this later on when we talk about internal controls. Anything that might keep us from meeting our objectives is risk. Think about the risk companies are incurring today because of the coronavirus. Information risk is the probability that the information upon which the decision was made was inaccurate. Auditors can help reduce information risk. The 3-month T-bill is usually used as a risk-free interest rate. Think about banks. If banks will charge a higher interest rate to a company that has a great deal of business risk. Similarly, banks are going to charge a higher interest rate to companies that have information risk. That's the one we can reduce or help reduce. Capital markets balance risk and reward. The higher the risk, the higher the required expected return. Notice I say expected return. What little money I have is in the credit union. I know what my return is going to be. If I invest in stocks, then I don't know what my return is going to be. It becomes an expected return. So the higher the risk, the greater the required expected return. Page 7, the book talks about different things that cause information risk and thereby create demand for audits. Remoteness, separation of ownership from management. If the owner's there every day running the company, he doesn't deal with this risk. But when we have separation of owner and management, as we do with most large companies, then that creates a demand for auditors to ensure that the information being provided by management is accurate. Similarly, the motives of the producer of the financial statements may be different than the motives of the user. Just think for a minute about the difference between bondholders and shareholders. Most common shareholders want companies to invest in risky investments, hoping to have a home run and a great return. Bondholders, on the other hand, want the company to be conservative. They want to make sure the company is able to pay the interest and the principal back. So the motives of the producers of financial statements are often different than the motives of the users. Volumes of data. Just think about the millions and millions of transactions that Apple needs to deal with. How do you sort through that data and present it in a manner that's usable by investors? Complex transactions. Complexity is the enemy of the auditor. It's more difficult to audit a complex transaction than a straightforward transaction. Assurance, attestation, and audit. This is not the definition of audit that I want you to learn. I want you to learn the one, I believe it was page 4 in the book. It's a little longer, but it's similar. Opinion about whether the financial statements are presented in accordance with GAAP. This is a short version. It's fine for what we want to do here, because all we want to do here is I want to make sure you understand audit is a subsection of a test, and a test is a sub of assurance. So assurance is the big umbrella. Under assurance falls attestation, and under attestation fall audits. Most public accounting firms have 3 lines of business: audit, tax, and consulting. Audit sometimes is called accounting or attestation. Consulting is now typically called advisory services. But almost all public accounting firms have these 3 lines of business. You're going to be hired as a staff auditor or staff tax person, and in public accounting, Usually you're going to report to a senior associate. There will be several staff reporting to that senior associate. Senior associate's going to report to a manager. Again, the manager will probably be overseeing several senior associates. The manager reports to a senior manager who reports to a partner. In order to sit for the CPA exam, you need a bachelor's degree, 225 quarter hours. 36 of those quarter hours need to be in business courses, and an additional 30 need to be in accounting. Of the 30 accounting, 20 need to be traditional accounting, and 10 need to be in ethics. After you pass the exam, you need 1 year of experience before you can become a licensed CPA. If you have more questions about this, see Jim Caney. He has handouts that provide a great deal more information about the requirements, education requirements for CPAs. Thank you. I hope that was helpful, and I will see you next week.